we are starting to discuss the SL1 previous paper, that was the online paper in December 2020. We will take up the 55% of the paper, which is the financial reporting paper, and the paper looks as very standard paper, but there would have been some challenges in doing the paper with a different way of answering. I mean, the way of conducting the exam was different this previous time. But anyway, the figures and the passing rates are little daunting, so I don't want to share the numbers with you all. That was mainly because the students had all this doom and gloom of online exams, and most of the students did not want to sit for the exam, and most of them have skipped the exam. Irrespective of all these, the paper looks very smart and standard, even especially the console question, especially the borrowing cost question, and we will start discussing the questions starting from the first one. We will go to question number 1, section 1. Ideal Private Limited, IPL, is a real estate company and its financial year ends on 30th June. IPL held the following properties as at 30th June 2020. Land in Athurugiriya. IPL acquired this land in August 19. For 10 million rupees, the company has not yet decided on how it would use this land in the future. The net realizable value as at 30th June 2020 was 13 million rupees, and the fair value as at 30th June 2020 was 13.7 million rupees. So, before I start moving on to the third and the second and the third part of the questions, let me look at the expectations of the examiner. Advise the management of IPL on the accounting treatment to be applied for the properties 1 to 4 above as at 30th June 2020. Advise the management on the accounting part of it. So, that is what the examiner expects from you all to do at the exam, accounting treatment to be applied. Accounting treatment to be applied. Now, I must persuade and convince you all guys that this is a reporting paper, and the main focus and the emphasis should not be on the mathematical calculations, which are just a support only, and your main focus and the emphasis should be on the reporting part of it. Advice, you need to give some instructive explanations on how each of these items will be recognized in the financial statements. Accounting part has to be advised. IPL has acquired a land in August 19 for 10 million rupees. The company has not yet decided on how it would use this land in the future. Now, you should be first and foremost technically sound, and if you do not know anything about the technicality, and you will be left in the lurch at the exam. And this is from LK investment property. So, how do we know that this is from investment property? It says this was a land, and lands of the buildings acquired for either capital appreciation purpose or rental income generation purpose should be investment properties without you being in a doubt. But the question, nowhere does it say whether this is for rental income generation or for capital appreciation purpose. That is where the problem is. LK's 40 standard clearly says in the list of examples given that if an entity acquires land with undetermined future use, should become investment properties. It is not picked from the definition of investment properties, that has to be picked from the list of examples given in LK's 40. So, the examiner is asking from there and this land has been acquired without setting a specific purpose as to what this land is for in the future. It may be to construct a office building, it may be to rent it out in the future, it may be to construct a gymnasium in the future, maybe sometimes to construct a graveyard to bury the dead carcasses of the people who work in the company, maybe to construct a theme park, and nobody knows what the hell this land is for in the future. No specific purpose, nobody knows what it is for. It would have been acquired just for the purpose of acquiring. If an entity acquires a land with undetermined future use, obviously it becomes an investment property. And then you convince yourself that this is from LKS 40, and you need to look at the accounting part of it. Investment properties are initially recognized when it is probable that the future economic benefits associated with investment properties will flow to the entity, and when the cost can be measured reliably. So, what is the initial measurement of investment properties should be the cost. Subsequent measurement, and LKS 40 has given you the liberty to make a choice of cost model or fair value model. But you can't make the choice just for the sake of making the choice blindly. Now, the latest version of conceptual framework wants you to look at certain other factors to decide what the subsequent measurement choice has to be. Basically, we need to take the business model into account, and that is a different story. Now, the question has been very specific, and the last paragraph of the question says, note, IPL prepares its financial statement using full SLFRSs and measures investment property at fair value. So, the examiner has explicitly given you the accounting policies in relation to the subsequent measurement. So, their choice accounting policy in relation to the subsequent measurement of investment properties fair value model. Now, we have another issue. So, the examiner has given you some figures to enable you to decide the subsequent measurement. On 30th June 2020, it was 13 million the fair value, or rather net realizable value has been 13 million, fair value has been 13.7 million rupees. Now, sometimes you can be in a horns of a dilemma whether I should select 13 million rupees or 13.7 million rupees, and that is because you are not sure about yourself and you are not technically sound. Subsequent measurement cannot be at NRV, it has to be at fair value. So, what is the fair value? Fair value should be 13,700,000. So, if you give a perfect answer, this is how you need to word it. A land with undetermined future use has to be investment properties as per LKS 40, investment properties, and LKS 40 requires investment properties to be initially recognized when the entity is certain of future economic benefits to flow into the entity associated with this investment property asset, and when the entity can measure the cost of investment properties reliably. Initial measurement has to be cost in accordance with the accounting policies built or adopted by this entity in relation to the subsequent measurement of investment properties. It has to be the fair value model. So, the subsequent measurement should be 13.7 million, and this fair value changes due to subsequent measurement of 3.7 million rupees should be recognized to profit and loss. And if you give that couple of informations in form of instructions given to someone, and that is what the examiner expects, and that has to be a solid answer. So, let us look at the suggested solutions of the examiner. Per LKS 40, land held for a currently undetermined future use is an investment property. Since IPL measures investment properties at fair value, this land should be measured at the fair value of rupees 13.7 as of 30th June 2020, and the fair value gain of 3.7 million should be recognized to profit and loss. We will move on to the second one. Land in Gampaha. IPL acquired this land for 30 million rupees with the intention of selling it in the normal course of business. However, the company is aware that it will take some time for the company to recover from COVID-19 pandemic, and it will be difficult to find buyers to sell this land. Therefore, IPL decided to rent the land to another company as a car park for a shorter period of time until the land is sold. The fair value of this land as at 30th June 2020 was 34 million rupees, and the net realizable value is 32 million rupees. Now, you will be left in a confusion whether we should continue to recognize the property under LKS2 inventories, or whether it has to be a transfer from LKS2 to LKS40 investment properties. Once again, that depends on how mastery and how good you are technically in the standard. But I must tell you something just as a support. Just imagine you buying a property, just a small amount at 1 million rupees. And this is purely for the purpose of constructing your office complex, and you know it has to be under LKS 16 property, plant and equipment. But you know, you can't start the constructions of an asset like an office building, office complex overnight. As soon as you want that to happen, you can't do it. Why? There are some activities that are inevitably needed to be completed. So, until you get the architectural plan done, until you get the approval for the construction from the parties, regulatory authorities concerned, without just keeping the land idle, you just thought of giving it to someone to use it as their vehicle park. I mean, you are giving that on rent to another party to use it as their vehicle park. And just because you are giving it temporarily until the constructions commence to use it as their vehicle park on rental basis, are you going to transfer it from LK 16 property, plant and equipment to LK sport investment properties? No. Why? The business model is very sound. Eventually, in the long run, the entire purpose you set for this land is not to get this land to generate a rental cash flow, but to get this land to contribute to our administrative work. Since that process will be little delayed, without just keeping the land idle, you just thought of giving it to someone for use it as their car park on rental basis. But it does not undermine your ultimate objective of getting this land to contribute to your administrative work. It does not guarantee that you have changed your business model from getting the land to contribute to administrative work to getting the land to contribute to a rental income generation. No. Similarly, you will apply the same scenario here. And what is this land for? It is for sale within the normal business activities. Irrespective of the magnitude, irrespective of the technology, irrespective of the nature of the asset, you categorize an asset under inventories LKS2 as long as the intention is to trade the asset within the normal business activities. It can be aircraft, it can be ships, it can be transport vehicles, it can be lands, it can be buildings, as long as you hold it for trading, for sale within the normal business activities, please put it under LKS2 inventories. And we know the pandemic situations that were spreading all over the world, and this pandemic that has engulfed into the trap, the entire world has been taken to the trap of this pandemic, and everybody became helpless, even including you and I. Even this company is now helpless and they can't find a buyer to sell this land to as soon as they want to sell this land. It takes sometimes, and as a result, till you complete your sale within the normal business activities, you have used it and you have decided to give it to someone for use on rental basis. But eventually, how does this asset contribute to a cash flow? That will contribute a cash flow from a sale transaction within the normal business activities. Just because temporarily you decide to rent it out to another party, there will not be significant changes to the business model. So, it has to continue to be under L case 2. And what has to be your perfect answer? Now, the examiner can be smart. The examiner tries to distract you. The examiner tries to misguide you by giving some or loading some information, and that is to assess your smartness in the technicality of the standard. Here you need to say the asset is for sale within the normal business activities and has to be recognized under L case 2 inventories. Just because the land is rented to another party to generate the rental income temporarily, the classification of the property should not be changed from L case 2 to L case 40. Why? The eventual business model of this asset is to generate a sales proceeds within the normal business activities. An initial measurement of inventory should be at its cost, which is 30 million rupees. Subsequent measurement should be in accordance with L case 2 inventory. So, what does it say? Inventory subsequently should be measured at the lower of cost and NRV. So, what is NRV? NRV is 32 million. So, you need not to take this fair value into account, just completely disregard it. And NRV is 32, which is higher than the cost of 30 million. So, you continue to recognize and measure inventory still at 30 million cost on the reporting date. Why? Cost is lower than NRV. So, that is your complete answer to score fully. Let us look at the suggested answers of the examiner. Property intended for sale in the ordinary course of the business is inventory. Therefore, this land should be reflected as inventory, and the temporary renting out of the land does not qualify it to be classified as an investment property. Accordingly, the land should be measured at the cost of rupees 30 million, which is the lower amount when compared to the NRV. So, the answer I have given you is little more comprehensive than the answers. So, the examiner expects you to give a solid answer at your level. Do not just say this is inventories and the initial measurement is cost and sub. It is not what is expected by the examiner at your level. And you will be happier saying that, thinking that I have given the answer and I have done my job. But at your level, in addition to the technicality and the smartness of your knowledge, also the professionalism in answering the question need to be tested, because hereafter you are not going to sit for any other exams, and this is your last stage, and what you need to, all what you have to show have to be shown here without keeping that for the future. And we will move on to the next one. Building in Panadura. This building was acquired in July 2019 at a cost of 20 million rupees. It had a useful life of 30 years. The building was occupied by 2 tenants under operating leases. Both tenants vacated the property due to the decline of their businesses resulting from the distressed economic environment under COVID-19. Therefore, the building was vacant as of 30th June 2020. IPL is trying to find new tenants for the building as at 30th June 2020, the fair value of the building was 22 million rupees. And there is something very interesting to know, that the way LK16 property, plant and equipment defines what property, plant and equipment are is not consistent with how LK40 defines what investment properties are. And you will say, obviously it has to be because there are two standards and the definition should be the same. That is not what I am talking about. Now, for an asset to be property, plant and equipment, you must make sure that the asset is in current use, either for manufacturing, either for administrations, either for rental or either for manufacturing, distributions, administration, rental. It has to be in the current use. But there is no requirement as such as far as investment properties are concerned. Why? Now, just imagine you holding on to a vacant building. It is vacant. But you are holding this vacant building for renting purpose in the future. So, one day or other, as soon as we can, and when the things get normalized as usual, this is during the pandemic situations, they think of finding some tenants so that we can rent it out and we can start making rental income. This is still vacant and it does not still make money. It does not make money. We are not in the process of earning the rental income. Why? This is still vacant. Even if it is not in the current process of generating the rental income to the business, still LKS40 recommends this property be recognized under LKS40. So, you will see some small nooks and corners are there in the standard which the examiner can be very interested in testing, and that is what is needed actually at this stage. So, you need to have a comprehensive understanding and you need to be mastery of the standard to answer a question like this. Irrespective of the fact that this building is still vacant, it can be classified under LKS40 investment property. And you need to highlight that fact. What do you need to highlight? What does the examiner expect you to highlight? A building which is vacant can be still classified under investment properties LKS40 as long as the entity is holding on to this vacant building for the purpose of renting out in the future and to generate the rental income. So, highlighting that fact prominently to the examiner is very important, because those are the expectations of the examiner and this is what the examiner expects you to understand. Then once again, as usual, your initial measurement has to be at the cost of 20 million and the subsequent measurement should be the fair value in accordance with the accounting policies adopted. And what does the question say? The subsequent fair value has been, the fair value of the building has been 22 million. So, this fair value gain of 2 million should be recognized into profit and loss. And the balance sheet has to show investment properties under current non-current assets at 22 million rupees, and that is your solid answer and that is what the examiner expects from you all. Let us look at the examiner's answer. The building is held to earn rental income. Even though it has been vacant since June 2020, the future use is also to earn rental income and therefore, this is an investment property and it should be measured at the fair value of 22 million rupees as of 30th June 20. The fair value gain of 2 million rupees should be recognized in the income statement. Now, my answer was little comprehensive and you need to always go extra mile to please the examiner. It does not say that you need to talk about everything in LKS40, no. You have to make it solid and perfect just to impress the examiner that you qualify to get 50 marks. Please remember, to make the first impression you will never get a second chance, and you need to jump and grab the opportunity, and don't keep part of the answer for yourself and give it to the examiner so that the examiner can assess you. We will move on to the fourth part. Building under constructions in Malabar. The cost incurred for constructions up to 30th June 2020 was 20 million rupees. After construction is completed, IPL will rent this building to a few educational institutions. The fair value of the work completed as at 30th June 2020 was 23 million. This building is being constructed on a land obtained under a lease for a period of 50 years. IPL prepaid the future lease payments amounting to 130 million rupees, prepaid rentals. Prepaid rentals are 130 million rupees. On 1st July 19, which was the date of the commencement of the lease, the fair value of the leasehold interest at 30th June 2020 was estimated at 135 million rupees. Fair value of the lease interest has to be 135 million. Now, you need to look at two aspects of the scenario. What are the two aspects? Obviously, the examiner is expecting you all guys to give the accounting treatment, instructions on the accounting treatment on the building aspect. So much so the examiner is expecting you all guys to give accounting instructions on the land element as well. And the chances of you either forgetting the building element or forgetting the land element chances are very high at the exam, especially under the exam environment, online exam mode. So, that is why you need to be so careful in answering this question. And I have talked to some students, and their feedback or their answering on this land element has been absolutely poor. Now, first we will talk about the building element. And this is a building of which the construction is still in progress. Now, the building is halfway completed. A building which is halfway completed can be property, plant and equipment or not, and that is the first question for which you need to seek answers. LKS 40 has been very clear, absolutely clear. Even if a building which is halfway complete can be recognized under investment properties if your ultimate eventual intention is to generate rental income. It is very clear. The standard explicitly gives that example, that explanation is given. So, without being hesitant, you can bring this property irrespective it was halfway completed, you can put it under, recognize it under LKS 40 investment property. Now, I am giving you something extra, and this has not to be part of your answer. If an entity applies fair value model for the subsequent measurement, there is a rebuttable presumption that investment properties or the fair value of all the investment properties can be measured. And rebuttable presumption is that we assume reasonably that we can measure the fair values of investment properties and there is no difficulty at all. But there can be some instances where this assumption is rebutted, meaning there can be some instances where the fair values of investment properties cannot be measured. One good example is within this question itself. Sometimes a building which is halfway complete does not have a reliably measurable fair value because nobody wants to buy that, and maybe sometimes even after using all our sophisticated techniques we still cannot measure the fair value. It may be the situation. Then, irrespective of the fact that we apply fair value model for the subsequent measurement, the building which is halfway complete or the building of which the constructions are still in progress can be continued to be measured at its cost. Once the fair value becomes apparent, then we can shift. It is not an accounting policy change, then we will start applying readily available fair values, and that is not what is tested in this question. I am just giving you something extra, and that problem has not been there in this question because the examiner himself has given us the fair value of this halfway completed building. How much? 23 million rupees. So, what is your answer now? Halfway completed building has to be investment property. If the entity has an intention of renting out and generating the rental income in the future, and initial measurement should be 20 million fair value, made a mistake, 20 million cost, subsequent measurement should be the fair value which is given 23 million. So, the changes in fair value gains of 3 million should be recognized to profit and loss. That is as far as the building element is concerned. And then the land element, I think I have discussed that part so clearly in our webinars of SLFR 16 leases. Unfortunately, we did not do LKS 14 webinar series, but we have done it SLFR 16. But this is not only spoken about in LKS 14, also we speak that in SLFR 16 as well. Now, say company A has a land and this is given to company B under a lease, and this land will be subleased to another party, C, sublease. Now, as far as company B is concerned, how should company B recognize this land in their books? Now, company B has taken the asset from the lessor, initial lessor A under a lease. Even company B has given that to another outside party under a lease, and this land that belongs to company B contributes to rental income, and this is a land which is held in the business of B for the purpose of generating rental income. So, you must be having a strong feeling that under no circumstances that this land should not be investment properties. No, because LKS 40, also SLFR 16 together say this land in the books of company B does become investment properties if two requirements are fulfilled. What are the two requirements? First and foremost, it has to fulfill the definition of investment properties under LKS 40. What is the definition? Definition has to be what investment property should be: a land or a building held either for rental income generation purpose or for capital appreciation purpose. That is already done, satisfied. Second requirement, for this interest, lease interest of the land, to be investment properties in the books of company B, there is another important requirement to be satisfied. What is it? Company B should apply fair value model for investment properties. Make sure the lease interest of the property has to satisfy and fulfill the definition of investment property first and foremost. Apart from that, the entity B would have adopted the fair value model for the subsequent or for the measurement of investment properties. All these requirements are fulfilled. So, as a result, even the land element in the books of company B should become what? Investment property. Even the land element in the books of company B has to become investment properties, and that is how you should develop your answering for this part. I have seen in many people, many students, and many of you all have ignored this land element, and you all have concentrated, focused only on the building element, thinking that we have done the best, but at the exam, the expectations of the examiner and your performances have a massive gap, and that is what we think of bridging now. You need to improve your standard of writing, however much you know. If your writing is not up to the expectations, is not to the optimum level, and then still you are underscoring. Let us look at the answer of the examiner. Per LKS 40, a property under construction and intended to be used for earning rental income is an investment property. Therefore, the building, this building is an investment property and should be measured at the fair value of 23 million rupees. As of 30th June 2020, the fair value gain of 3 million should be recognized in the income statement. The land on which the building is constructed meets the definition of investment property, since the property will be used to earn rental income based on para 34 of SL1 16. IPL should apply the fair value model. That is what I said. To the right of use asset, that meets the definition of investment property in LKS 4. Therefore, as at 30th June 2020, the right of use asset should be measured at 135 million. And 5 million should be recognized as fair value gain in the profit and loss statement. I hope it was clear, and then we can move on to the second part of it. Part B of the question. IPL purchased the land to construct an apartment complex on 1st January 18 for 30 million rupees. The company spent 2 months on planning activities, and on 1st March 2018 the planning approvals were obtained. The development of the land was also completed on this date, and construction commenced immediately after obtaining the approvals. The estimated cost of construction was 150 million rupees. Construction was temporarily suspended due to COVID-19 from 11th March 2020 to 10th March 2020. On 30th September 2020, the apartment complex was ready for sale except for a few modifications in some units to suit buyer specifications. All these modifications were completed on 15th October 2020. IPL made the following payments to the contractor. Phase 1, 1st March 18 40 million, 1st January 19 30 million, phase 2, 1st August 19 20 million, 31st December 19 30 million, phase 3, 30th June 2020 20 million rupees, on 30th September 2020 10 million rupees, total payment 150 million rupees. The following information is related to IPL's borrowing. On 1st January 2018, IPL obtained a loan of 100 million rupees specifically for the apartment complex project at an annual interest rate of 14%, which is equivalent to the effective interest rate. The loan is repayable over 5 years. At an annual amount of 29 million rupees, IPL earned interest income of 1.7 million rupees by temporarily investing the funds until the payments were made to the contractor. Second one, phase 2 and phase 3 of constructions were financed by IPL's existing borrowings. Details of the existing borrowings of the company during the constructions period are given below. A loan obtained at 12% per annum had an outstanding amount of 20 million rupees. As at 1st August 19, this loan was fully repaid on 1st October 2020. Debentures issued at 13% per annum had an outstanding amount of 35 million rupees as at 1st August 19, and this remained unchanged as at 15th October 2020. A loan obtained at 11% per annum had an outstanding balance of 50 million rupees as at 1st August 19. The amount was fully settled on 15th November 2020. Required advised the management of IPL on the borrowing costs that should be capitalized to the apartment complex according to the requirements of LKS 23 borrowing cost. Right. Now, that is a very good question. The single question is testing almost everything of LKS 23 borrowing cost. Now, we know LKS 23 that speaks about the borrowing cost, the accounting prescription for borrowing cost, stipulates two recommendations to accounting treatment for borrowing cost. If the borrowing cost is incurred on qualifying asset, borrowing cost on qualifying asset should be capitalized. Should be capitalized. And other borrowing costs should be expensed to profit and loss immediately. Now, even LKS 23 defines what qualifying assets are. Qualifying assets are the assets that necessarily require a substantial time period to get ready for use or for sale. So, each and every single letter, each and every single full stop and a comma in that definition carries a meaning. A substantial time period may be required to prepare the asset. Necessarily, a substantial time period may be required to prepare the asset to intended level of use of a sale condition. And you can go through the standard from the beginning to the end, to the beginning from the middle to both ends, just to see where the substantial time period has been defined. Nowhere does it say what it is. And it is quite judgmental, and there is no universally accepted norm to measure what the substantial time period should be. But what is existing in the practice is normally it is considered to be a 1 year's time, and there can be plus and minus either way. Not either way, and there has to be at least 1 year more than that, but there can be some changes. Now, if you apply that requirements to the asset which the question speaks about, and we are starting to we are starting to construct this building on 1st January 2018. And it becomes ready for use of a sale towards end of 2020, towards end of 2020 years. Now, it takes more than 2 years, takes completely 18, takes completely 19, it takes the better part of 20 as well. So, in accordance with the technical definition of qualifying assets of LKS 23, this fits very much into the definitions of a qualifying asset. So, it has to be a qualifying asset. So, which accounting treatment do we use then? You cannot expense the borrowing cost and you should capitalize the borrowing cost. What do you mean by capitalizing borrowing cost? Capitalizing borrowing cost is you adding the borrowing cost as part of the cost of the building. Then, even when you decide to capitalize borrowing cost, you can't just do it just for the sake of doing. Why lot of criteria to be looked into, and there is a framework within which we have to be. What is the framework? You decide to capitalize the qualifying assets borrowing cost, and again for you to commence the capitalization of borrowing cost, you need to look at 3 more criteria. What are these 3? Make sure the expenses on the asset are being incurred. So, what does it say? Not that does it say that we haven't still started constructing the building, and what it says is that already we have started the construction of the building and we keep incurring expenses on the asset. Maybe we are paying for the contractors, we are paying for the advance payments to the people who will do the ceiling, maybe we are in the process of receiving the regulatory approval and we are paying for that, and we are hiring people, we take the assets on hiring, and we are in the process of getting the architectural plan done, and we are in the process of buying materials, paying for the labor. Those expenses on the asset are being incurred in the process of incurring the expenses for the asset. Second one, the borrowing costs are being incurred. Borrowing costs are being incurred. You know what the borrowing cost is, and you all are matured enough to understand that concept, and I can't keep you on my hands and start to do the spoon feeding. You all should know what the borrowing cost is. It's any cost incurred in connection with the borrowing. It's open-ended. The definition is open-ended. Why you need to decide what it is. Any cost incurred in connection with the borrowing should be borrowing cost. You must be in the process of incurring the borrowing cost by now. Third is what should be the most important one. I mean, it's not so straight to understand. You need to understand it anyhow. What does it say? The activities necessary to prepare the asset to its intended level of use or sale have begun. And this is what most of the people do not understand the way it should be understood. What does it say? Now let me talk about 2 separate assets. I mean, we are going to construct a building, but before the building you need to buy the land. On 1st January 2020, we bought the land and we have taken all the required regulatory approval, we have paid and we have done the site preparation as well. It is just a matter of starting the construction of the building. Now, you are in the process of receiving the regulatory approval, you are in the process of receiving the architectural plan, and you are in the process of recruiting people, you are in the process of taking the assets and the machines on hire, and you are in the process of paying for the surveyors, you are in the process of paying for the legal personnel, for the legal charges. You do everything except for the fact of you starting the constructions, physical constructions on the site, and you yourself can't see this building emerging. You do everything except for the fact that except for the commencement of the constructions physically, you do everything now. Still, the activities necessary to prepare the asset to its intended level of use have not begun. So, what does it try to say by beating about the bush? What does it say us indirectly? For the third one to be satisfied, what you must do is inevitably is to construct and to commence the construction physically. Until such time you commence the construction physically, the third requirement is not satisfied, and then only you can start capitalizing borrowing cost. Say, starting from 1st January 2020, you have kept on incurring legal charges, you kept on incurring architectural fees, you kept on incurring some fees to the government to take their regulatory approval, you kept on paying for the materials, you kept on paying for the machines, rental for the machines, you have taken them on hire, but still you haven't started the construction physically, and that occurred only on 1st July 2020, and that is the starting point of capitalizing borrowing cost, and that is a must, and that is what you need to cement and anchor in your mind. Unless you know that, this entire question will be messed up, and that is what most of you all have done at the exam. But now, here there is a little exception. The land and the building are inseparable. I mean, the land and the building should not be taken as two different assets and should be a single asset. And having bought the land, if you prepare the land in a way that we can commence the physical construction of the building, that should be considered to be the starting point at which you start the activities necessary to prepare the asset to the intended level of use. And that is very important at the exam. Understanding the reality of the scenario is absolutely important, without just being a book reader and you are going to be a practical accountant. So, to some extent you should be able to read the mind of the examiner as well. Then you can go on capitalizing borrowing cost until which point? Until the construction is complete. That is not how the standard says. Until such time the asset is available or the asset is prepared to the required level as intended by the management. Now, certain things may not be so clear. The question is, on 30th September 2020, the apartment complex was ready for sale, except for few modifications in some units to suit the buyer specification. Now, if you complete the construction of a building, certain modifications may be required depending on the requirement and the purpose for which the building will be used. Suppose we are going to use the building for an office complex and you need to do some internal modifications to make it suitable for an office. Suppose we are going to use the building for a mortuary, and then again you need to do certain developments within the building to make it suitable for a mortuary. And if the building is going to be used for a restaurant, once again some internal modifications are required to make it suitable for a restaurant. So that depends on what purpose the building will be used for. But it does not mean that the building is still not ready for use. It is still ready. So LKS 23 says that having certain modifications to be done, having some modifications to be done does not mean that the asset is still not ready for use. It is still ready, depending on for what purpose the building will be used. Certain modifications may be required. Just forget it and disregard it. And modifications are not the part of the construction process. So disregard it. And what is the date on which the building can be considered to have been completed? That is on 30th September 2020. So starting from 1st January 18 right up to 30th September 2020, you need to keep capitalizing borrowing cost subject to the requirements of LKS 23. So that's what you must do, ladies and gentlemen. I am convincing you all over and over again, this is not a mathematics paper where the calculations are the be all and end all. That is not the requirement. This is a reporting. So the calculations will be just a byproduct, that is only a support for your reporting. As a result, do not waste on doing the calculations to the last decimal point and you will not score. What is required is to give the accounting instructions, do this, do this, do this. You have the gadgetics, you have the devices, you have the softwares to get the calculations done. So let them look after their babies. What is our job to be done? You need to give the accounting instructions. There the calculations are not that important, but here we will give the calculations with the utmost accuracy. Let us get on with the calculations now. So you know the tenure starting from 1st January 18 right up to 30th September 20. First one, it says on 1st January 18 IPL obtained a loan of 100 million specifically for the apartment complex project at an annual interest rate of 14%, which is equivalent to the effective interest rate. The loan is repayable over 5 years at an annual amount of 29 million rupees. IPL earned interest income of 1.7 million rupees by temporarily investing the funds until the payments were made to the contractor. If borrowings were specifically done for the purpose of financing the constructions or acquisitions of a qualifying asset, the calculations are very straightforward. So the first one is very simple. I will do the calculations with utmost accuracy, but you can round them off and you can do the calculations in millions, and let me not do it because I am giving you the help and the support. Let me calculate the borrowing cost to be capitalized. In total, borrowing cost to be capitalized We have taken this loan specifically for the financing of the construction of the building. It was 100 million. So let me first work out it on for the year of 2018, 100 million into 14%. Interest amount should be 14 million. Then for 2019, and during the construction period, the entity keeps paying the loan by how much? 29 million rupees. So, as and when the payments are done, the outstanding capital figure reduces. So, even the interest calculation should keep reducing over the construction period. So, for 2019, you know, as before you take the calculation, you must do a small calculations extra. What is it? Annual payment is 29 million, which is comprising of the capital plus interest both. In this, included in this 29 million payment in the first year end, should also include the interest payment of 14 million. So, the capital payment should only be how much? 15 million rupees. So, even if you pay 29 million rupees, the capital portion gets deducted only by how much? 15 million rupees. At the beginning of 2019, the outstanding capital balance should be 85 million rupees. This is what interest rate should apply on. 85 million into 14% should be 11,900,000. That should be the amount of interest to be capitalized to the construction cost for the second year. Then before you take the interest for 2020, again let us work out on the outstanding capital balance. You paid 29 million rupees end of 19. Included in the second payment is the interest payment of how much? 11,900,000. So, let us work out on the capital payment. 29 million minus 11,900,000. So, the capital payment was 17,100,000. Let me work out on outstanding capital balance should be 67,900,000 into 14%. Now, in 2020 there was a small issue. What was it? There was a suspension of the active development in the construction, and that is an area where LKS 23 gives special guidelines. You need to sit and see whether the suspension was caused by a technical reasons or caused by a non-technical reason. You know, sometimes when in a small construction process, when you put the concrete pillars up and you will put the concrete slab across, and then the carpenters, what they say is, you need to leave this concrete slab just alone by exposing it to the rain and to the sun, so that it will get the required strength to solidify the materials over 3-4 months time. To strengthen this concrete slab, you need to just expose it to the sun and the rain over 3-4 months time, and that is part of the construction process. And if you start constructing the first floor on this concrete slab instantaneously, it does not last for a longer period. So, delaying that over 3 months time is a technical reason, but here they have delayed it over 2 months time. Was it part of the architectural plan? Was it as a requirement of the nature of the construction? No, it was due to another reason, pandemic, COVID-19, not a technical reason, and 2 months seems to be substantial in the context given. So, as a result, for the year of 2020, how many months were there? There were 9 months. Why? You can keep on capitalizing until 30th September, but out of 9 months you need to forget about 2 months time, so you can capitalize it only for how many months? 12 months time, sorry 7 months time. So, let me do the calculation, that into 14% divided by 12 into 7. So, the amount that you can capitalize is 5,545,167. Let me take the total down. $167, this is 5, this is 4, this is 4, 31,445,167, and until the funds were utilized for the constructions, we had invested the funds in some temporary investment venues from which we have earned 1.7 million rupees temporary investment income. Effectively, the amount of borrowing cost to be capitalized should be the net amount of the borrowing cost after deducting whatever the investment income you earn. So, let me deduct it from here, minus temporary investment income, 1,700,000. So, let me take the total now, the final figure, 31,445,167 minus 1,700,000, it is 29,745,167, 29,745,167. That is the amount to be capitalized. And what did the examiner want us to do? Advise the management. Okay. So, let us do the advising part after completing the calculations we started now, right. And the first part of the construction, phase 1, has been completely financed out of the bank loan specifically taken to finance the construction of the building. And the phase 2 and phase 3 seems to be a complete hodgepodge. Why? Lot of instruments are combined and jumbled and tangled together. You do not know which is which and which loan has been for which phase. Everything is mixed up together. So, you need to sort it out nicely. Then, where the borrowings have been done in common, you need to first work out on a capitalization rate. Capitalization rate, common rate has to be calculated, and that calculations almost takes the calculations form of weighted average cost of capital in your finance management. Same way, same concept, different methods are there, but let me stick to the method which the examiner has adopted. Then you have gone through it already, I know, then you have kind of a familiarity. Now, what are the loans generally borrowed? Phase 2 and phase 3 of constructions were financed by IPL as existing borrowings. Details of the existing borrowings of the company during the construction period are given below. Loan obtained at 12% had an outstanding amount of 20 million. 20 million at 12%. Debentures issued at 13% per annum had an outstanding amount of 35 million rupees. You need not to take the figures as they were, you can just put 20 million, just 20 at the exam. Second one, 35 million at an interest rate debentures of 35 million at 13% interest. Third, 50 million where the interest rate has been 11%. Now, nobody knows 20 million has been used for phase 1 or phase 2 or phase 3 or phase 4. Nobody knows phase 2 was financed out of the first loan or the second loan or the third loan, and they all would have been taken to a common account and mixed up and tangled and jumbled together, and this is the account from which they extract funds from to finance the constructions. So, every single cent, every single rupee that you draw from this common account will have a common cost, which is including 12%, which is including 13%, and which is including 11% as well. So, we need to do a flat calculation which can commonly apply in all these sources of financing. Let me put the total down and do the weightage. Total is 105 million. To do the weightages, you divide 20 by 105 into 100. So, this is 19% of the entire funds. 35 divided by 105 into 100, and this is 33% of the entire funds, 33%, 33, 50 million divided by 105 into 100, so this is 47.619%. Now, let us take the multiplication, this into this, 19.047 into 12%, and that should be 2.286, 33.33 into 13%, this is 4.3324, 4.3329, 3329. This one $47.619 into 11, this has to be 5.2381. Take the total down, 2.286, 4.3329, 5.2381. So, this has to be 11.857. This is the common rate which you can apply on all the sources irrespective of at what rate they were borrowed, which date it was borrowed on, and let us see how it has been financed. It has been released for the construction now. Then phase 2, what is the cost? 20 million into 11.857 divided by 12 into how many months? That was paid on 1st October 19, starting from that date to 30th September 2020, how many months are there? 14 months. Divided into 14. 20 million into 11.857 divided by 12 into 14. It has to be 2,766,000. 2,766,633. Then there was another payment for phase 2 on 31 December 19, 30 million. 30 million into 11.857 percentage divided by 12 into how many months? Starting from 31st December 19 to 30 September 2029 months. Should be 2,667,825. 2,667,825. And phase 3, there was another payment. Phase 3, there was another payment on 30th June 2020 at 20 million. 20 million into 11.857% divided by 12 into how many months? 30th June, July, August, September, 3 months. 20 million into 11.857 divided by 12 into 3, 592,850. And for the last payment 30th September 2020 for 10 million, you need not to work out on interest, but it was paid exactly on the completion date of the construction. So, let me take this total interest down. 2,667,825 plus 2,766,633, 6,027,308. Right, and that has to be the amount to be capitalized, but still we have another issue. What is it? During the year 2020, the project has been idling for over 2 months' time, and that was not due to a technical reason. So, the borrowing cost relating to the period during which the asset was idling cannot be capitalized. So, I have taken the calculations even including the period during which the asset has been idling. So, let me now calculate and exclude the amount of interest incurred for 2 months period during which the asset was idling. First one, let me forget it for the specific loan taken for the construction, loan number 1. Let me do it in the second one. Here I have taken this figure 6,027,105 even including the borrowing cost incurred during 2 months period during which the asset was idling. Now, I need to remove it. I can't capitalize the whole amount. You need not to do the calculations for phase 2. Why? Because you paid it on 1st August 19 and 31st December 19. I made a mistake. You need not to do it for the payment done in phase 3, June 30th, 2020 and 30 September 2020. Why? Those payments were after completing the idle period. So, you should work it out only for the phase 2 payments 20 million and 30. I hope it was clear. 1st August 19, 31st December 19, those payments are the payments made for the work from 1st August 31st December right up to the date of the completions, and the work relating to those payments were the work which were idling during the 2 months COVID period. So, then borrowing cost for idling period that is 20 million, 30 million altogether 50 million rupees into 11.857 divided by 12 into 2. 50 million into 11.857 divided by 12 into 2, 988,083. 988,083 should be deducted and the balance amount should be capitalized. And also for the specific loan taken, we have removed it already, but that removed amount, we have taken only for 7 months in 2020, though the completion has taken 9 months during the year of 20, I have taken only for 7 months after excluding the idle period. The interest incurred during that idle period should be taken to profit and loss, not to the cost of the qualifying asset. So, let me show it elsewhere now. First loan, the amount of interest to be expensed this is 2 months idle period, 2 months idle period. And remember, you can also do another calculation. Why? What? After 30th September, you cannot capitalize borrowing cost, and for the loans, for the borrowings after 30 September to 31st December 2020, for that period, after completing the constructions to the end of the reporting period, the interest component has to be expensed. I will not show that calculations, I do not have enough space, you can do it leisurely. How much? 67,900,000 into 14% into 2 months, that is for the first loan 67,900,000 into 14% divided by 12 into 6, 12 into 2, made a mistake, 12 into 2, how much? 1,584,333 has been excluded from the cost to be capitalized, it has to be expensed to profit and loss immediately. And these are the calculations. How will you develop your answer? You must say that LKS 23 defines the qualifying asset, you need to give that definition. So, this asset fits into the definition of a qualifying asset. Why? It takes necessarily a substantial time period to get ready for use of a sale. Then you need to say that the borrowing cost, LKS 23 gives 2 accounting prescriptions: capitalizing borrowing cost incurred on qualifying asset, and that is what this particular scenario fits into. So, you should start capitalizing borrowing cost, but before you capitalize, you need to comply with some requirements. What are the requirements? Before the commencement date has to be decided after fulfilling 3 requirements, which I showed you before. You must make sure that the borrowing costs are being incurred, you must make sure that the expenses on the asset are being incurred, you must make sure that activities necessary to prepare the asset for intended use or level have begun, you must explain them, you must give them in as part of your answer. And you cannot go on capitalizing borrowing cost until any date. You must make sure that you stop it and you cease it when the asset is substantially ready for use of a sale. So, that is on 30th September. Subsequent modifications are not considered to be part of the constructions. They are further changes to suit the requirements of the asset depending on the requirement nature of the final user. And if the asset is idling, and if that delay is caused by non-technical reason, the borrowing cost incurred during that period should not be capitalized, it has to be expensed to the profit and loss, and that has to be a complete your answer, and you need to give that answer together with the calculations, and then only you will score the full marks. And we will move on to the next question. We are moving on to Question number 2, part A. As of 31st March 2020, Target PLC had the following financial instruments. The accountant is not sure whether these instruments meet the solely payments of principal and interest contractual cash flow characteristics test. Let us look at the requirements required. Evaluate whether the instrument in 1 to 4 above meet the SPPI contractual cash flow characteristics test. SL1 is 9 financial instrument. Now, SPPI test, solely the payment of principal and interest. Contractual cash flows are what are expected for the SPPI test to be test to pass for any financial instrument. And contractual cash flow, these two words include many things inside. That includes many things right within. So, basically that has to have 3 characteristics, and you would have watched our webinars on financial instruments. SL1 is 9. What is the first one? You must make sure that for the cash flows to become the contractual cash flows, that we should receive the cash flows from the very party whom the cash flows have already been given to. And the contents of the cash flows should include only the principal and interest, and even interest has to be further subdivided, and you need to further look into the components of interest cash flows. That can include only time value of money plus risk. It can be the credit risk, it can be default risk, risk has to be there, plus it can include also the margins of the lender, marks up to the lender, and third one, the contractual terms need to specify the dates to contractual cash flows. So, let me put that on the board. Cash flows should be received from the party whom the cash flows had been given to. Second, contractual terms should specify the dates to contractual or to cash flows. Third, the cash flows should include only the payments of principal and interest. Even interest should include time value of money, risk, marks up or margins of the lender. In other words, the characteristics of this arrangement of this instrument of lending should be similar to the characteristics of a normal lending arrangement. That is what is needed. So, I can't go into the details of this, it takes a long time, but if you watch the videos or the webinars sessions, you will be able to brush up the basic principles and the theories of SPPI test. First one, it says investment in a bond that has a maturity date at 31st December 2025. Maturity date is given. So, what does it say? Contractual terms should specify the dates to contractual cash flows. That part is complete. Subjected to a variable rate based on the prevailing market terms, the variable interest rate is kept at 9%. You know, sometimes the rate is fixed, or sometimes the rate can be variable. It happens. And the variable rate has been given. Having that been given, the rate has been kept at 9%. What does it say? Partly the rate is variable, partly the rate is fixed. So, here the both fixed and variable rate both are given. But that does not undermine the characteristics of a normal lending arrangement. So, nowhere does the question say that this interest rate includes anything other than time value of money and payments for the risks, and that is apparently is including only the payments for time value of money and for the payments of risks. Even this, the third requirement is satisfied, and the first is what cash flow should be received from the party whom the cash flows had been given to, and that is apparently obviously is satisfied unless the examiner says something otherwise to the contrary. So, all the three requirements are satisfied for the cash flows to become contractual cash flows. So, the first one can be classified under, or the first one can be considered to have passed SPPI test. So, that has to be the answer for part 1, Roman simple number 1. Number 2, investment in 5% convertible bonds, redeemable in 5 years. Each bond is convertible into 2 ordinary shares of the issuer at the option of the holder at any time during 5 years period. Right. Now, let me take some arbitrary figures. If the value of the bond is 5 million and if this is convertible into 500, I am taking some different figures for the illustration, 500,000 shares into which it can be converted, and if the market price of a share in the future will be say 15 rupees, so the lender receives how much? 7.5 million rupees. And the interest payment seems to be like what? 2.5 million rupees. And that does not include this. The interest payment should include the payment for time value of money and for payment of risks. And if you take the time value of money and the risks, the 2.5 million cash flow must be way more higher than, that would have higher than for the payment of time value of money and risks. So, this does not include the required characteristics of a normal lending arrangement. And on the other hand, if I put that in a different way, the repayment of the bond is connected to an equity index. If it is connected to an equity index, once again the required characteristics of this arrangement for that to be a normal lending arrangements will disappear. So, then the second has not to be, cannot be considered to pass SPPI test. Why? It is connected to an equity index. Third one, a loan given to another company repayable in 4 years at a fixed interest rate. The borrower has the option to repay the outstanding principal amount and the interest on the outstanding principal amount at any time before the end of the 4-year period, together with any penalties per the contract. Now, we have normally a repayment period, say it is 5 years, but at the same time the borrower has given the option to the lender, look here, I am going to repay this at any time over 5 years time. But you know, even if you take a normal loan, the early payment will be discouraged by the lender by imposing a penalty payment. If you want to repay the loan early, and that early repayments will be discouraged, will be like impeded or will be barricaded, like by imposing some penalties. So, the more penalties you are supposed to pay, the more discouraged you are to repay the loan in advance. Early settlements will be discouraged. But as long as these penalties do not undermine the characteristics of a normal lending arrangement, there is no problem. Still that passes SPPI test, and the arrangement is like the normal lending arrangement that we are familiar with. So, even the third one passes SPPI test irrespective of the penalties charged, as long as the penalties will not undermine the characteristics of a normal lending arrangement, as long as it does not disqualify the characteristics of a normal lending arrangement. So, that is what your answer has to be for third part. Fourth one, a loan repayable in 5 years given to a related party at a low interest rate than the market rate for a similar loan. That is not a big issue, we have discussed this before. Say we are granting 5 million rupees now, and this is to be recovered in 1 year's time. Market rate is say 10%, but we are charging just 0% interest. So, we are giving the fullest possible concession to the borrower. And now as you recognize it initially and measure it initially, it has to be at fair value. To measure it at fair value, what we normally do is to discount it by the market interest rate. I am not doing the exact calculation, just imagine the present value becomes 4.5 million rupees. Now, it is like not you having granted 5 million rupees and then receiving 5 million rupees in 1 year's time. It is like you having granted 4.5 million rupees and receiving 5 million rupees in 1 year's time, and this balance 500,000 is like you giving some concessions, and let us see how it is accounted separately. So, here if you recognize 4.5 million rupees expecting 5 million, this is like you giving this loan at market interest rate of 10% expecting 5 million rupees, and this looks almost like normal lending arrangement, and this again passes SPPI test, and that is your answer for question number 1 part A. Let us look at the examiner's answer or CS Sri Lanka answer. Contractual cash flows of a variable rate instrument meet the SPPI test provided the interest rate reflects the considerations for time value of money and credit risk. Since the variable interest rate is based on market terms, it seems the above criteria is met. Since the instrument has an interest rate cap, it has features of an instrument with a fixed interest rate as well. Through the interest rate cap, the variability of cash flows is reduced. Such an instrument meets the SPPI contractual cash flow characteristics test. Second one, SLFRS 9 requires the terms of a convertible instrument to be analyzed in its entirety. The interest rate for this type of a convertible note does not reflect only the considerations for time value of money and credit risk. In addition, the hold is exposed to additional business risks as the return is linked to the value of the ordinary shares to the issuer. Therefore, the SPPI test is not met. Third one, contractual cash flows that are solely payment of principal and interest on the principal amount outstanding are consistent with a basic lending agreement arrangement if the penalty is reasonable to compensate early termination, and the early terminations option is not contingent on any future even this loan meets the SPPI test, as it is consistent with the basic lending arrangement. Fourth one, per SLFRS 9, the principal is the fair value of the financial asset at initial recognition. Accordingly, the fair value of this loan is the present value of future cash flows. Using the market rate of interest, the difference between the loan amount and the fair value is the interest. Accordingly, based on the terms of the loan meets the SPPI test. Right. So, we are moving on to question number 3. Consolidation part, and this is the bread and butter in the part, and this is where most of you all have got stuck at the exam. It is a very good question, not that it is hard, but it is a bit of a tricky one, and you need to, that needs lot of thinking that should go into that. Without the required thinking going into that, you can't complete the way it should be completed. So, as you know, as you attempt to this question number 3, you need to have your pre-scene ready with you. Part A, in order to expand the overseas business operations and achieve its vision for the future, on 1st September 19, HCL acquired 35% of the ordinary shares of HCD BD, that is Bangladesh company. HCD had acquired 80% of the ordinary shares of Healthcare India Limited HIL on 1st January 17 for rupees 55 million. The following transactions took place on 30 September 2020. Edward had a 10% direct shareholding in HCD Bangladesh. He transferred his 10% direct shareholding in HCD to HCL with the agreement of the other shareholders of HCD. The consideration provided to Edward comprised of an immediate cash payment of 250 million rupees, one new share of HCL for every 5 shares held in HCD, and 150 million rupees LKR payable after 3 years if HCD achieves at least a 10% growth in net profit at the end of 3rd year. However, there is only a 70% probability of achieving this growth target due to the prolonged COVID-19 pandemic. HCL invested in the entire 60,000 convertible bonds issued by HCD to manage its financial stress caused by the COVID-19 pandemic. These bonds have a face value of 10,000 LKR each with a 3-year terms. Interest is payable at 8% per annum. The entire investment is convertible at any time up to maturity into ordinary shares of HCD at a conversion price of LKR 60 per share at the option of HCL. The exercise price of this option is in the money and is expected to remain the same over the term of the bonds. HCL acquired 25% of the 80% interest held by HCD and 20% of the 20% interest held by the non-controlling interest NCI in HIL at a cost of 30 million rupees LKR. The following tables summarize the equity basis of HCD and HIL as at 1st December 19, 30 September 2020, 1st December 19 company, 30 September 20 company. So, the figures are in LKR million. I will not read the figures, you can see it for yourself. HIL as at 1st January 17, as at 30 September 2020, capital figure is given voting rights, retained earnings given, revaluation surplus is given. Additional information: the fair values of a share of HCL and HCD and HIL as at 30 September 2020 were estimated at LKR 70, LKR 53 and LKR 25 respectively. In September 2020, the head office of HCD was shifted to a building provided under a lease by the Bangladeshi investor at a relatively low rent. The value of the right of use asset per the terms of the agreement amounted to 250 million LKR as at 30 September 2020, and the present value of future market rentals of a similar lease amounted to 375 million rupees LKR. This leasing arrangement is not recognized in the financial statements of HCD. Considering the current COVID-19 impact on the business, the directors of HCL are planning to terminate some of the employees of HCD and HIL. The estimated redundancy cost is 50 million LKR for HCD and 25 million LKR for HIL. The directors of HCL are planning to announce this officially to the employees in end December 2020. HCL Group's policy is to measure NCI at fair value at the date of acquisition, use a discount rate of 10% for relevant calculations. The income tax rate for all three companies 28%. The group adopts Sri Lanka accounting standards. SLFR SSL cases when preparing its financial statements. Prepare a briefing note to the board of directors of HCL that includes an analysis of the financial reporting implications of the transactions given above in the consolidated financial statements of HCL in accordance with the applicable accounting standards. Now, when I shared some views of students after the exam, what I noticed was they got stuck in this question because they were holding on to the calculations longer, and all day long they got stuck in the calculations and the entire question has been messed up. So, once again I must tell you, the calculation is not the entire requirement. You need to give a briefing note where the calculations will be only just a support. And if you feel that you can't complete it within the given time, at least identify the group structure and you need to give the briefing on accounting. You will get some marks or other. Now, you all would have lost marks on the console questions because you all were given the priority only for the calculations, not for the briefing part of it. To explain, to prepare this briefing note to the board, calculations will not be, calculation should be there, but for you to get some marks, some amounts of marks, calculations will not be that required. You need the calculations to be included to make it a perfect answer, but to get some marks, to get 50 marks, you can include the briefing part with the group structure and the accounting part, and that is what we have been missing, and that was one reason for the failure. So, you need to stay positive. Being positive does not guarantee the success, but being negative guarantees the failure. So, you need to stay positive always. And this is a very good question, and let me start with the group structure now. Group structure. If you see page number 9, they have given the examiner in the pre-scene, page number 9 has given us the shareholding structure of HCL, that is the parent company. Healthcare, this is Healthcare Leisure Private Limited, HCL. HCL, right. And out of 100%, already Mr. Edward is holding 30%. 30% is holding 30%. Now, as per the pre-scene, that is page number 4, second paragraph, the first sentence says, in December 19, HCL bought 35% of stated capital of Healthcare Drugs Bangladesh Company. Let me call it BD Bangladesh Company. They had already acquired 35% on 1st December 2019. So, what seems to be the reporting date like? If you look at the expectations, its reporting date seems to be like 30th September 2020, 30th September 2020, right, 30th September 2020 should be the reporting date. Now, the pre-scene has given us the financial statements of Bangladesh operation as well. In the Bangladesh operation, Bangladesh company, if you see their balance sheet, the balance sheet shows us investment in subsidiary company. Already this Bangladesh company has another subsidiary company, the details of which are given only in the unseen. This is Hill and this is operating in India, right. So, this is like a group structure on one hand, provided the adequate information is given on the reporting date 30 September 2020. What are the additional information given for us to further strengthen our group structure? Right. Edward had a 10% direct holding in HCD. He transferred his 10% direct shareholding in HCD to HCL with the agreement of the other shareholders. Edward has been a major shareholder of the parent company as well. So, he has been having some individual personal investments in Bangladesh company, and then he has transferred his 10% holding in the Bangladesh company to HCL. So, then HCL has altogether how much? 45% by 30th September 2020. Remember, 35% had already been acquired somewhere, that is on 1st December 19. This additional 10% being acquired from Edward has occurred only on 30 September 2020. Now, the cumulative equity holding goes up to 45%. Now, with 45% can HCL start controlling the Bangladesh operation? You need to apply the control model of SLFRS 10. Now, with the information given with 45% direct holding, direct voting rights, you can't control. Then if the majority voting rights are not there, you need to look at the others. You need to look at the potential voting rights, and you need to look at the contractual arrangements, and also you need to look at the de facto power. To establish the de facto power, the information is not enough, and the contractual arrangements are not apparently given in the question. But the question has given an important fact of information. What is it? HCL invested in the entire 60,000 convertible bonds. Bangladesh company has issued 60,000 convertible bonds. This is convertible into ordinary shares. Convertible debt instrument is a potential instrument. Then you need to assess whether these potential instruments are substantive or not substantive. The examiner has been very kind hearted, very generous with open hands, and he himself says this convertible bond is deep into money, is in the money rather, in the money. In other words, HCL exercising this convertible option or the option attached to this convertible bond to acquire additional ordinary shares is very much likely, HCL is very much likely of exercising the option attached to the convertible debt to acquire additional equity shares. How many shares additionally? It is given the entire investment is convertible at any time up to the maturity into ordinary shares of HCD Bangladesh at a conversion price of 60 per share, 60 rupees per share at the option of HCL. Now, what does it say? Convertible bonds 60,000. What is the value of a bond? Face value of a bond is 10,000, and this entire value can be converted into shares of how many shares, and the value of a share has to be 60, and let us work it out. 60 into 10 is going to be another 10 million ordinary shares, 10 million ordinary shares. How many shares are there in Bangladesh company? Bangladesh company has 750,000 shares. And what is the value of a share? It was given in the pre-scene. It was given in the pre-scene. Page number 9 says ordinary shares issued at TK10, this is 10, it has to be 75,000, 75,000. Then let us look at the group structure, let us look at the group structure. Now, already HCL has 45% in Bangladesh. Also, we need to take into account this potential voting rights. Potential voting rights will enable HCL to exercise another how many shares? 10,000. So, then Bangladesh company has already 75,000 shares, you know how this figure was taken, 75, and this will be added by another 10,000. So, altogether it is going to be 85,000 shares, 85,000 shares. Now, out of 85, HCL had acquired already 35%, and that was 35%, 75,000 into 35% was how much? 26,250. And from Edward, HCL acquired another 10%, that was 7,005. 7,005 out of 75,000 before you take in this potential voting rights into account, 7,005, and it is going to be another 10,000 new shares into which the debt instrument is going to be converted into. The total is going to be 0, this is 5, this is 7, 3, 43,750, 43,750 divided by 85,000. So, it is going to be 51.47 altogether, 51.47. Now, including, now SLFRS then requires us to consider potential voting rights in establishing the control or the power, and with this potential voting rights only, HCL has 51.47 voting rights at the decision making process. So, then HCL can be considered to have acquired what? Can be considered to have acquired the control over company BD Bangladesh operations, and you need to give this calculations as a support. Total number of shares in Bangladesh company 75,000 into 35%, 26,250. Then acquisition from Edward, 75,000 into 10% should be 7,005. Then another potential voting rights, of another 10,000, total 43,750 divided by 85,000. How does it come? Already they have issued 75,000 shares, another 10,000 will get added with this conversion option, convertible instrument, it is the potential voting rights. This into 100, let us work out on the percentage, 43,750 divided by 85,000 into 100, so that is 51.47. So, you can consolidate company BD as a subsidiary company of HCL by 30th September 2020. So, that is one important aspect. Remember, starting from 1st December 2019 to 30th September 2020, HCL was holding only 35%, and it is on 30th September 2020 that the equity holding or the voting rights rises from 35% to 51% altogether. So, what you must understand here is the fact that you need to consolidate BD Bangladesh operation as an associate company starting from 1st December 19 to 30th September 2020, and then it becomes a step acquisition on 30th September 2020. So, there are two aspects now: consolidating the Bangladesh operation as an associate company, and then to consolidate Bangladesh company as a subsidiary company on 30th September 2020, and Indian company has to be taken separate. Let me now go to the required calculations of Bangladesh operation first, and then let us go to Indian operations later. In consolidating or in recognizing an associate company using the equity method, we need to remember three aspects. Recognizing the investment initially at cost, and subsequent equity changes need to be adjusted to the investment account, and the investment balance and equity method has to reflect the equity holding in the associate company. And let us complete that part first. Recognizing Bangladesh operation under equity method. take the pre-scene, and they had HCL had invested 984,500 initially, and that is shown in the parent company HCL balance sheet. Initial investment 984,500. Now, there is one important area which will get neglected by all. What is it? Now, say company A was the parent, company B was the subsidiary company, and company B had another subsidiary company in the name of C, right. And company B had 100,000 equity on the acquisition date of company A. They acquired significant influence, and this equity figure changed from 100,000 to 150,000 just as of the reporting date. So, the investor has to recognize subsequent equity changes of the associate company to the investment. And what is likely of being neglected by all is that the equity changes of this associate company B is not only because of their own equity changes, also because of the equity changes of their subsidiary company. Now, equity changes of company B should be picked and taken to investment not from the individual books, from the group that company B has prepared. Company B has to prepare consolidated financial statements including C, why C is a subsidiary company of B. So, the equity changes, whatever that have occurred from the acquisition to the reporting date, should not only be because of their own equity changes, also due to equity changes of company C. Then, let us look at it. Here, the group and company figures are given of the Bangladesh operation. First December 19 figures are given, 30th September 2020 figures are given. So, in between the changes have to be the equity changes. Foreign exchange reserve. Foreign exchange reserve it has been 444 on the reporting date, and on the acquisition date of 35% it has been 322. This into 35% should be recognized. 444 minus 322 into 35% should be recognized. How much is it? 42,700. It is added to the investment account, 42,007. Reserves and retained earnings. Reserves and retained earnings. What are the changes? 1858 now on the reporting date minus 1581 on the acquisition date of 35% into 35%. How much? 1858 minus 1581 into 35% should be 96,950. 96,950. Also NCI figure is given. What is the NCI figure? This Bangladesh company had another subsidiary company, and as Bangladesh company consolidates their own subsidiary company, NCI figure has to be there in the consolidated financial statements. So, do not forget about the basic principles. NCI is recognized under liability, so under equity, NCI has to be part of equity. Then if the investor HCL recognizes subsequent equity changes of the associate company, even the changes of NCI should be recognized to the investment. Why? NCI changes are also the equity changes of the associate company, and that has to be very clear. Why does it come here? Because we recognize company B as an associate company, and company B has been a parent company of another subsidiary company. So, their equity changes should not be just only their equity changes, their equity changes should be the equity changes on their own plus equity changes of their subsidiary company. So, we should recognize 30%, 35% from the consolidated financial statements of the parent company, where NCI is shown as an equity figure. If equity changes are recognized to investment, even changes of NCI should be recognized to investment account. How much? NCI 20 minus 18 into 35%. 20 minus 18 into 35% is how much? Just 700, and take this figure, total 984,500 plus 42,700 plus 96,950 plus 700, it has to be 1,124,850, 1,124,850. So, in your briefing note, you need to address this issue. 35% enables to exercise significant influence right up to 30th September 2020. Till then, over a couple of months time, Bangladesh operation should be an associate company under equity method. So, you need to explain the equity method, and then you need to give how it is accounted for the way I have shown here in the board, on the board, and this has to be part of the answer. Now, we are on 30th September 2020, on which we acquire the controlling power. So, you need to consolidate Bangladesh operation as another subsidiary company where the goodwill is required. To support that, you need to give the revised group structure with the previous calculations, group structure, how that 51% comes, and let us get on with the goodwill calculation now. Goodwill calculation of Bangladesh company. Right. The original 35% should be measured at fair value, and for us to measure it at fair value, they have given us the market prices of shares of all the three companies. All the three companies' fair values are given. Right, 75,000 shares, you know how it was taken, into 35%, how much? 75,000 into 35% is 26,250, and Bangladesh company has a market price on the acquisition date of 53, this has to be multiplied by 53 to calculate the fair value of original 35% holding into 53. How much? It is 1,391,250, 1,391.25. Then you will take NCI, because they have their policy of valuing NCI at fair value, plus NCI at fair value, right. You have to be careful, because we take, that has to be extremely cemented in your memory. We are considering, we take into account the potential voting rights only for the purpose of establishing the control. But to do the consolidation, you take only the current existing ownership. When you do the consol, it has to be on the basis of 45% to the parent and 55% to NCI. Don't get confused. We take the potential voting rights into account only for the establishment of the control, but for the consolidation part of it, we will go by the existing ownership of 45% to parent and 55% to NCI. So, out of 75,000 rather, parent is holding currently 45% and non-controlling shareholders are holding 55%, and let us take the NCI at fair value, this into 53, 75,000 into 55% into 53, how much? 2,186,185, 2,186,185, right. And let us take the other considerations. Edward, or before that, in order to expand the overseas business operations and achieve its vision for the future, on December 1st, 19, HCL acquired 35% fine of HCD. HCD had acquired 80% of ordinary shares of Healthcare India at 55, we will take it later. The following transactions took place. Edward had 10% direct shareholding of HCD BD. He transferred his 10% direct shareholding in HCD to HCL with an agreement of the other shareholders. The consideration provided to Edward comprised of an immediate cash payment of 250 million, cash consideration 250 million. One new share of HCL for every 5 shares held in HCD. HCD 75 million into 10% is 7,005, and for every 5 shares received from Edward, HCL is going to issue 1 share divided by 5 into 1. This is to be measured at the fair value of the parent company shares. It is given in the question, and it is 70 rupees. Let me take the figure, 7,005 divided by 5 into 1 into 70, that has to be 105 million. Then, and another 150 million payable after 3 years of if HCD achieves at least a 10% growth in net profit at the end of the 3rd year, which is a contingent consideration. Contingent considerations are taken at the fair value. How is the fair value determined? Take the future value and into the probability and then discount it at the market interest rate. So, this is 150 million into 70%, and we are given the discounting rate is 10%. So, this is divided by 1.1 to the power 3. 150 into 70% divided by 1.1 to the power 3. How much? 78.88. 78.88. So, the fair value of the previous 35% investment was taken, NCI figure was taken, and cash consideration was taken, and non-cash payment is taken, contingent consideration was taken. So, this is the total considerations to be taken for the goodwill calculations. Let me take the total now. 1391.25 plus 2186.25 plus 250 plus 105 plus 78.88, total has to be 4 billion rather, say in millions, 4011.38 will deduct minus the net assets at fair value on the acquisition date. Right. So, let us take the figures. Company share capital 1485, then foreign exchange reserves, how much? 440 million. Retained earnings reserves, retained earnings are how much? Retained earnings on 30th September 1850. Then it says in additional information, it says the fair values of a share, okay fine, it was taken. In 30th September 2020, head office of HCD was shifted to a building provided under a lease by the Bangladeshi investor at a relatively low rent. The value of the right of use asset per the terms of the agreement amounted to 250 as at 30th September 2020, and the present value for future rentals of a similar lease amounted to 375. The leasing agreement is not recognized in the financial statements. So, we should recognize the asset of 125, how does it come? 375 minus 250, 125, and the related deferred tax minus related deferred tax on ROU, 125 into, let us look at the deferred tax rate given. Tax rate has to be 28%, 125 into 28% should be 35, deduct it and then take the total net assets at fair value and then complete the goodwill. 1485 plus 440 plus 1850 plus 125 minus 35, it is 3865, 3865, then take the goodwill, 4011.38 minus this, goodwill has to be 146.38. So, that is just one aspect of the calculations, and then let us get on with the Indian company. HCL has acquired now 45% in Bangladesh, and Bangladesh has already acquired 80% in HIL. Right. Now the question says, HCL acquired 25% of 80% interest held by HCD and 20% of the 20% interest held by the non-controlling interest NCI in HIL at a cost of 30 million rupees. Of HIL, 80% is held by Bangladesh and the balance is by 20% NCI. Now, HCL is acquiring 25% of the equity holding of BD in HIL. So, BD is holding 80% in HIL, 25% of that 80% is another 20% is added here, 20%. Now, HCL has a direct holding in HIL of 20%. Then Bangladesh equity holding in Indian company reduces from 80% to 60% now. It is only just 60% now. So, what is the indirect holding by HCL in HIL through BD? It is another 45% into 60%, 45% into 60. It is another 27, so it is altogether 47. Now, the question also says HCL acquired another 20% from 20% non-controlling shareholders, 20% on 20% NCI, 20% into 20% is another 4%. So, the total rises from 47% to 51% now. So, HCL is holding directly and indirectly 51% in Indian company. So, even HIL has to be consolidated as a subsidiary company of HCL by 30th September 2020. Let us complete the goodwill for that as well. Goodwill calculation. Direct investment, how much? Direct investment has been 30 million. And Bangladesh company has already invested how much? Bangladesh company, you need to look at the LKR figures. Bangladesh company has already invested 984,500. Bangladesh company 984,500. From this, we can take what percentage? 45%. 984,500 into 45% is how much? 443. I made a mistake, it is not it's not this amount. I have taken a wrong figure, it has to be investment in subsidiary is 55,878, 55 878 into 45%. 55,878 into 45% is 25.14. 25.14. Then we will take NCI. NCI, Bangladesh or Indian company. We are given the figures of Indian company as well. By 30 September 2020, Indian company has 5 million ordinary shares. 5 million into 49% should go to NCI. 5 million into 49% NCI should be measured at its fair value. We are given the market value of Indian company as well. Indian company share price is 25, so that into 25 is 61.25. NCI at fair value should be 61.25. Let us take the total 25.14 plus 30, it is 116.39, and let us deduct the fair value of net assets. Fair value of net assets on the acquisition date. How much is it? On 30th September 2020, share capital should be 50 million and retained earnings should be 63, and revaluation surplus on revaluation should be 10. Total 50 plus 63 plus 10, 123, deduct it minus 116.39, 6.61 should be what? Gain on bargain purchase. Gain on bargain purchase, and this has to be recognized to group profit and loss immediately, and this is what you need to include in your compiled briefing note to the management or to the director board, and if you present everything you will get full marks, and that is the end of our discussion of the paper. I wish all of you all will get through the exam. All the very best.